going on, mortgage borrowers? Thought I'd throw out a video today because I'm a little excited. About what's going on in our market because there sure is a lot, I'll tell you that. Last week, November 30th, was a big day in our market just due to some changes that we had. I say market meaning the mortgage world, really. Here in Canada anyway, if anybody sees this from somewhere else. To add to the changes we had from about 6-8 weeks ago with the new qualifying rates for high ratio mortgages. So and we've seen some collateral damage kind of hit with the conventional mortgage market as well, and some changes that are coming. So what do I mean when I say that? So just as a recap, right? High ratio mortgages. Anybody that's got less than 20% down, minimum 5, but less than 20, you guys have to pay mortgage default insurance. We know that. We also know that the max you can amortize your mortgage for is 25 years. We know that. Conventional mortgage, anything that has 20% or more, either down payment or equity, right? If you've got any of those, so if you're refinancing or you're transferring, it doesn't matter. But if you've got 20% equity in your home, then you are a conventional mortgage. And we've seen that, so we know that the high ratio people, they have to buy, they get mortgage default insurance, but they have to qualify in the higher rate. We know that. But with the conventional mortgages, what we've seen is a whole bunch of changes because conventional mortgages cannot be insured the way they used to be, which kept the costs for conventional mortgages down. And now we've actually seen that the lower risk conventional mortgage market, because it would be lower risk because you have more money, more stake in that game, more skin in the game on that, your prices are about to go up, which is very interesting, disappointing, because you worked hard to get to that point, and it's going to cost you more to be there, which seems a little bit counterproductive. I have some statistics that I'll list here too, but you can take a look at them. But as I read them off, they come from one of our top mortgage agents in Canada, one very well-known man by the name of Rob McLister. I can't say them any better than this, so I'm just going to give them to you the way he said them, and I completely believe that they are true. But here's an idea. So, and remember, you can't refinance till you've got 20% equity in your home anyway. So this affects those people. And then if you've got your 20% down as well, then that's going to affect you too. So if you're buying, you're refinancing, you're thinking of doing it, this could have an impact. This info can have an impact on not if you want to or if you have to, but how you go about doing it. And that's going to be the question. Example, typical new rate surcharges on refinances, they're 15 basis points higher. So that means if you refi, it's going to cost you 15 basis points more than it would have about 6 weeks ago. Number of broker lenders who have terminated refinances altogether, 6. You got 6 less players in the market who are willing to do refinances because of the cost of them now and the fact that they just don't have the backing to do it. Typical new rate surcharge for AMs over 25 years, 10. So if you're going to refinance, push your amortization back to 30 years to make your payment more manageable and just play with it a little bit, you can't. You can, but they'll charge you 10 points more than they would have. Number of lenders who have terminated AMs over 25 years altogether, 7. Again, we dwindle down the competition. It just leaves less opportunity for competition, which typically ends up in higher rates. Typical new rate surcharge on single unit rentals. This is wild. 15 to 20%, 15 to 25 basis points. So what that means is you used to be able to get best rates, A rates, if you were buying a 1 to 4 unit rental property. That's its own thing, that's fine. Now you're only going to get those really good rates if you buy a 2 to 4 unit property. The single family home, the townhouse, you're going to pay 15 to 25 basis points more for that thing. I'm sure there's some strategy behind that. I haven't necessarily figured out what it is. Probably has something to do with foreign buyers and that whole thing that they were completely worried about, which may not be as worrisome as they once thought. But that's tough for you investors out there for sure. Now, again, if you understand your numbers, that's not going to deter you too much. And if you have a question about why I say that, leave me a comment. I will explain my thought to you on that. But I don't think that should worry anybody, really, because of the way you can do your accounting legally to just negate that. But it still sucks. It still sucks if you're someone who needs the monthly cash flow. That's where it hurts. Number of lenders who have terminated rentals altogether, 6. 6 people just said, nope, we're out. No more rentals for us. Thanks very much. Typical new rate surcharge on properties over $1 million, 15 to 25 points. How many lenders have pulled out of that market altogether? 5. So again, I don't think that's going to affect us a lot here in Ottawa. Obviously, there's $1 million market in Ottawa for sure. But that's really going to see the impact in Toronto and Vancouver, where single-family homes on average are over $1 million. So that's where that's going to hit a lot more, because you just, again, don't have the competition. You're going to have to come up with a sizable amount more money, and just overall cost is going to go up. And in general, right, $1 million home, that 15 basis points, that makes a big difference on $1 million home. You don't feel it so much on 100 grand, you feel it on 10 times that for sure. Now, again, some of this can change. These lenders will probably come back to the market at some point, and we'll get back to square eventually when the investors and the money people figure out the best way they can do it, if they want to do some niche products and stuff. But don't be surprised if there's a surcharge for that special product that you need. Longer AM, different rental, $1 million home. We've already seen it, and when they come back, they're probably going to do it again. Now, here's an interesting thing too. Number of lenders who raised all their rates last week across the board, and this has nothing to do with bond markets at this point. They just said, yep, we're just going to, boom, move them all. We've had 4 lenders do that. Pretty sure a couple of them are the banks. I'll have to double check that, so don't quote me on that. I'll have to double check, but that's happened for sure. And this is the biggest one that I find tough to swallow. The number of lenders with better rates on their higher defaulting, low equity insured mortgages, essentially your high ratio mortgages, than lower defaulting 20% plus equity conventional mortgages is 18. That means you will get a better rate if you are higher risk. And have the mortgage insurance, you will get a better rate than if you are lower risk and have 20% down, 20% equity. That's tough to swallow. That is tough to swallow for the people who have given themselves an opportunity or been put in a situation where they could avoid paying that insurance. You're going to get nailed on your long-term game, your payment today, your more, insurance, your interest, over the life of your mortgage. That's where you're going to get hit. That's tough. That is definitely tough to swallow for sure. There's always going to be a way to spin it to make it look good. You're going to pay it off faster. You're going to whatever. But at the end of the day, it could be interesting to see if someone's buying with 20% down to say, maybe it's better to put down 19%, pay a couple grand in mortgage insurance, get a 15-point break on my interest rate, and then see what the end number is. We'll have to play with that a little bit and see, but that's what I think that's where the conversation is going to go. I'm pretty sure, and I mean that's what's going on. I wrote some notes here because I want to make sure. Right, the conventional market, that's collateral damage. I think it's unfortunate, and business is business, so people have to make sure they're making money. Like, lending is not a charity. They're going to have to make money, so they got to cover that with rates. And what's the plan, I think, for people? If you ask me, the plan is education. You have to educate yourself, or get with someone who's willing to educate you and put those numbers ahead of you. We have one lender right now that we're using it kind of as an example. They do their regular 5-year fixed stuff, and they have a couple different types of products within that same 5-year term. They have 18 different rates for a 5-year. 18 different rates for their group of 5-year products. That's wild. They might have had like 3 before. Now they have 18 because it's all dependent. Is it a rental? Is it a 1, 2, 3, or 4 unit rental? Is it a refinance? Is it a transfer? Is it, all that stuff is in there. And that's where it's going to get really gnarly, because the more lenders we have, the better competition, but the more we have to figure out what you're doing and where we can put you that best suits you on all levels. It's not just going to be what's your best rate, what's your best rate, what's your best rate. Because the fact of the matter is, you're too complicated for me to just tell you what my best rate is. We're going to have to do some work to figure out where you fit and what the best options are for you. And again, I think another big thing is that we have to keep this stuff in perspective, right? Rates have gone up 15 to 25 basis points on the highest end so far. That's still the majority of rates are under 3%. Under 3%. Is that bad? No. A few years ago, people were giving me their left arm to get a rate at 2.99, right? Is it bad for the market and what's happened in the last 6 months? Sure. But it's not a bad rate. It is not a bad rate. And that's the thing. Get away from the rate conversation. Let's have a product conversation. What's the best option for you? How do we make this work for you in your situation? And how do we spin this so this is going to make sense and work? I don't mean spin it. I just mean make it work for you. Don't worry about it because you can't. That's what they are. They're like that now. And again, perspective, 1980s, 18 and 24%. And I know there's people out there that are going to say, oh yeah, but incomes and for this and yes, I get that. I get that. But it's all relative. It's all relative, right? And right now, 3% to 4% on 3% on an A deal and still less than 4% on a B deal is dynamite, if you ask me, right? And I can show you stuff all day that says why that is. But this is the stuff that's happening. So I really want to hammer across that this is going to be about education and understanding how these numbers work and how they affect you. It can't just be, yeah, here's my mortgage and here's my payment and I'm done. I mean, it can if you want it to be. But if you really want to understand if you're getting the best deal and the best overall thing, you got to work with someone who's going to run you through that stuff. And that's what I think the big thing is. So this is kind of turned into a rant, so I'm going to kill this right now and just stop this. But education, education, education. My YouTube channel is up. We're going to be posting several videos there, more of like a series that's going to have a lot of stuff to go with, the terminology, playing with a couple numbers, nothing too boring, but, just some education pieces so people can understand, you can understand what's actually happening and what's going on and what you need to be worried about, and some little tidbits in there of how to, do good with your mortgage, right, and make it work for you a little bit. But as always, I'd love to hear some feedback on this stuff and maybe even what some of the concerns are that people have, because if you have a question, guaranteed, like the teachers always said, you should have raised your hand because someone else had the same question as you. But that's the stuff. Ask the question, right? The YouTube channel's there, Facebook, Twitter, Instagram. Snapchat's more for fun, but if you want to send me like a funny like voice changer thing with a cool question, that would be neat. I'm okay with that. It's fun. So, but again, get with the people that you're working with, whether it's me, whether it's somebody else, get with those people and ask them what the best option is, not just what the best rate is, because I don't know if we can do that anymore. I really think it's just got to be down to what the best product is and what's best for you. It always should have been, but now I think even more than ever, that's what it's going to have to be to get you where you need to go, wherever that is. Anyways, thanks for watching, and any questions, leave them in the comments. Chat with you soon.